Let me now also welcome on board Rajan Sethuraman, the CEO at Latentview, joining in on the show right now. Rajan, hi, morning. Good to have you on the show. You've seen a modest quarter this time around, despite a challenging demand environment. Do you expect this growth to sustain in FY25?
Yeah, good morning, and thanks for having me on the show. Yeah, it's been a bit of a tepid quarter. We were expecting that quarter four could actually give us a much bigger uptick than what we saw. But as you're probably hearing from other IT services companies, the demand environment continues to be a little challenging. At this point in time, I would say that the first half of the year, it'll probably play out along similar lines that we saw in the last quarter. And hopefully things will pick up steam in the second half of the year. I know that this is what I had said about the last year as well. But unfortunately, that is what the demand situation is at this point in time. We are very happy, though, that in a challenging environment, we were able to deliver about 19% growth rate in the last year.
Okay. But tell me, what factors are making you bullish right now? And where do you think growth is going to come in from and get that push?
So for us, there is always growth on the back of new ideas, both with the existing accounts as well as new conversations that we are initiating. It is typically the new ideas that we are able to put on the table that generate the leads. So at this point in time, there are 3-4 areas that we are really doubling down on. One is the entire generative AI space with our solutions, Laser and AI Pen Pal. We are continuing to see quite a bit of traction. And what were pilots earlier are getting converted into engagement, so we will see some traction on that. We are also investing heavily in the Microsoft Fabric ecosystem. And Fabric could be an alternate for a more integrated tech stack for many companies, right, that are really looking to drive their data analytics initiatives. And thirdly, we also announced a partnership with NVIDIA. So we are expecting that there'll be a big push on the back of that partnership. And of course, I've already updated about the acquisition of Decision Point, which brings very strong revenue growth management capabilities right to the table. So it's really on the back of the new ideas and the new capabilities that we are able to bring to the table that we see some interest.
Fair enough. And I wanted to also touch upon what the outlook is when it comes to your margins as well, because there has been expansion in the quarter gone by this time to 23.5%. Do you think that this level is sustainable? And if so, what will be the factors that will drive your EBITDA margin?
For the full year, it should be sustainable. I know that there'll be a bit of a dip in the first quarter on account of the compensation increases and the higher wage bill. We also onboarded pretty much all of the campus hires to whom we had made offers. So I'm expecting that there will be a bit of a dip that will happen in Q1. But from Q2 onwards, it should come back. In fact, our current projections are that we should be able to get close to the 25% mark towards the end of the year, so that the overall for the year, the EBITDA is about the 23% mark.
In FY24, your growth was led by technology, industrial verticals as well, but retail, CPG, BFSI were a bit muted. Tell us, what's the outlook in terms of verticals for FY25? What's going to fire?
So technology will continue to be a fairly strong mainstay, but we are seeing a lot of traction in consumer vertical, also on the back of the Decision Point acquisition. In fact, the last couple of weeks, I was in conversation with our accounts as well as with the clients that Decision Point works with. I was in the US and in Mexico, meeting with many of them. There is a great deal of excitement on the cross-pollination that is possible. So Decision Point clients were excited by the prospects of capabilities that we bring on R&D and innovation, supply chain, on-shelf availability. And at our end, there's a lot of interest in revenue growth management as a capability. So I'm expecting that consumer will grow a lot faster than what it has been in the last year. Our expectation is that in a couple of years' time, consumer could contribute up to 20%. In terms of overall revenues. So today, they are in the high single digits. The second vertical where we are also doubling down on is the entire banking financial services space. We are expecting that there will be some good uptick in this year, right, in that vertical. Industrials is also starting to see some good action. But I would say if I were to kind of order the verticals, it will be technology, consumer, and BFSI and industrials, right, in that order.
And given that, the overall demand sluggishness had impacted revenues, we understand that the environment could persist. Are you worried about that? Or are you, as you were saying, pretty confident that you will continue to win large discretionary projects and that is not going to be a challenge?
No, I think there is definitely a concern. At this point in time, I would only say that we have cautious, we are cautiously optimistic about how things will pan out in this year. We are excited by the prospects of the new ideas and capabilities that we are putting on the table, and that is resulting, at least in many leads and conversations. How many of them will convert into very large opportunities? That remains to be seen. But obviously, this will generate a lot of pilots, experimentation, smaller initiatives. In fact, I would say that the entire last year has also played out along those lines. There are only a handful of $500,000 plus initiatives, right, that we were able to win. We have a few which are $2 million and above in the pipeline at this point in time. But the discretionary spending, as you say, right, is a bit muted. And the expectation is that at least the second half of the year, things will look much better.
Note, Rajan, we let you go. Thanks as always for joining in.
Yeah, thank you. Bye-bye.
If you like this video, then like, share and subscribe to ET Now.